How to find stocks that are worth buying. Have you ever wondered what makes the difference between a professional investor and an investor who only invests in stocks just to look cool? Making the choice to park your money in the right place is something that will decide how comfortable your lifestyle is going to look like in the next 10 to 15 years. Now, there is no need to fear. We've prepared an exciting opportunity for you to learn and explore the strategies and the correct ways an investor should pick stocks so you could easily actually be called a seasoned investor, not someone who is embarrassed of his mistakes in the stock market. Here in this video, we will discuss some things for you to consider if you have decided to make the stock market a part of your portfolio. Stay until the end of this video to know what are the ways that can make you able to pick stocks that are worth buying. And what are those worth buying Indian stocks where you can invest in 2022? Let's not waste a single moment and dive straight into the main takeaways. Takeaway number 1. Do research on the business and learn its capabilities. Studying several companies is the first step in mastering the art of stock picking. Knowing the basics of a business could give you a good idea of its potential for success and growth. Market success often comes from a company that makes many people want to buy its products. Think about the company's capacity to continue providing such services. For example, how do you believe people will still use shampoo in the year 2030? There is a yes to this question. It has persisted for nearly a century and will continue for decades. Perhaps the preferences on its scent will shift, but the market for shampoos itself will remain. Let's look at another case. Can you tell me your thoughts on DVDs and CDs? How common do you think will those be in the year 2030? The possible response is no. Similar is the case in investing. If you're going to invest in the Indian stock market, choose a stock that will be around for at least 15 to 20 years. That's how you will sustain to make profits from your investments in the long run. Takeaway number 2. Calculate the company's PE ratio. Check the price to earnings PE ratio to see whether a firm is reasonably priced against its competitors. The PE ratio reflects the price at which buyers are willing to part with $1 a year in profit. So a PE ratio of 10 means investors are willing to pay $10 for every $1 profit the company makes. The price to earnings ratio, PE ratio, is calculated by dividing the stock price by the company's net profit for that year. The earnings per share figures are often reported in a company's yearly financial statements. Most stock PEs can be found by doing a simple online search for the stock symbol with the words stock chart. For example, the AAPL stock chart, with the most relevant result displaying the firm's current PE. A high PE ratio may signal that the stock is expensive compared to other firms in the same industry. So, a low PE for a growing business may mean that it is a good deal and an investment. For example, if we talk about the Indian stock Nifty, Nifty's average PE during the last 2 decades has been close to 20. Consequently, it is possible to find promising investing possibilities with a price-earnings ratio PE of less than 20. Takeaway number 3. Use a stock's beta to gauge its potential risk. The beta of a stock may be used to estimate its historical volatility. The beta of a stock is its volatility relative to the volatility of S&P 500. A corporation with a 5-year performance that significantly deviates from the S&P 500 has a high beta. In general, a beta greater than 1 indicates a riskier investment. Companies with a beta below 1 are considered safer investments. When you check a company's chart on a stock screener like Yahoo or TD Ameritrade, you'll often see the stock's beta shown with the other information, such as its return and dividend yield. For example, the investor seeks to find Tesla's TSLA beta relative to SPY. Recent data over 5 years shows that Tesla and SPY have a 0.032 correlation, whereas SPY's variance is 0.015. Consequently, TSLA is 113% more volatile than SPY theoretically. However, more reward comes with greater danger. On the other hand, a value closer to 1 might be better if you want a more stable company whose performance has been similar to that of the S&P 500. Historically, an underperforming stock with low beta and high risk trailed the S&P 500. But this means that your returns will be lower than those of a company whose beta is bigger. However, market volatility makes you less at risk of complete financial ruin. Takeaway number 4. Stocks that provide a high dividend should be your investment priority. The dividend is another important consideration when investing in stocks. You can make money from a stock's price increase, but dividend-paying stocks give you a steady income stream. If a company has a high dividend, it is a good chance that the dividend will be paid regularly. In any case, you should be careful of returns that look implausibly high. Sometimes, a firm trying to recruit investors can do so by offering a greater dividend yield. Moreover, it's possible that recent increases in output won't last. Ideally, you want a stock to yield between 5% and 8%. In the eyes of some shareholders, this is an acceptable risk for enough dividends. Finding dividend aristocrats is another option. These dividend-growing companies have grown their payments annually for at least 25 years. The dividend yield may be lower than average for these companies. It's safe to assume that businesses will remain steady over the long run. Furthermore, the likelihood of a dividend reduction being implemented is lower for these businesses. Takeaway number 5. Become skilled at reading stock charts and recognizing patterns. Using charts may be helpful if you want to learn about investing in particular stocks. If you want to know how to read stock charts, you may be able to learn a lot about how a company has done over time. You may also see the results in the short term, which can help you spot patterns as they develop. With the help of stock charts and trends, you can tell which stocks are doing well and which are poised for a breakout. There is no specific method of market timing using historical data and current patterns. However, you can still reasonably estimate a stock's short and long-term performance. Takeaway number 6. Invest in stocks for the long term. Sometimes it's better to invest for the long haul than to time the market and choose high-growth stocks. It would help if you focused on value when locating attractive stocks. Find undervalued stocks relative to their potential future gains based on objective measures. Learn how to identify firms with sustainable growth. An excellent starting point may be the dividend aristocrats. Alternatively, you might analyze the company's long-term profits and profit margins. If a business has a track record of success and is agile enough to respond to market shifts, it will likely be there for the long haul. The potential gains from an investment might be diminished by trading too often. Trying to time the market is risky, and you can lose money. Instead, consider a plan that will enable you to put your money into companies that will still be trading and paying dividends in the future. Takeaway number 7. Don't stop educating yourself. There is no way to know how a stock will do in the future or whether it will be a winner. But you can improve your portfolio's chances of doing well in the long run if you know what to look for when buying stocks. If you look how to discover solid stocks, you can ride out market fluctuations and still make money in the long run. Remember that you may build a profitable portfolio without learning how to choose stocks. Instead of trying to pick the right companies, some investors buy index funds or exchange-traded funds, ETFs, to get a feel for how the market is doing. Don't rush into a decision. Consider your options seriously. The next step is to educate yourself on the most effective investing methods. Bonus takeaway. Don't forget to check the market cap and the profit yield of the stock. The market capitalization of the stocks should be at least more than 10,000 crore rupees. To put it another way, it's the price at which one should acquire all of the company's shares. Market capitalization often fluctuates with the stock price. It indicates the company's size. The bigger the market capitalization, the less volatile and risky the company is expected to be. So, big market size is an excellent way to compare companies and pick the best long-term stock to invest in because it guarantees profits with less risk. The net profit of a business takes into account everything it does, while operational profit only looks at the main business. It shows the company's actual profits after taxes and profit on the debt are considered. After deducting all of the business's expenses, the remaining amount is the net profit and is known as the bottom line. Worth buying stocks in India, you need to know in 2022. Number 1. Reliance Industries. One of the finest long-term investments is Reliance Industries Limited. This Indian conglomerate provides services in the oil to chemicals OTC, oil and gas, retail, digital services and financial services sector. As a technical indicator, Reliance Industries' 52-week high-low represents the highest and lowest prices the stock traded over that period, about a year. As of June 15, 2022, the 52-week high for Reliance Industries is 2,856.15 rupees, and the 52-week low is 72,016.25 rupees. Number 2. Tata Consultancy Services TCS. Tata Consultancy Services Limited TCS is Indian IT services and business solutions provider. It is considered a low-risk investment. As a technical indicator, the 52-week high-low compares the highest and lowest prices at which a share of TCS stock has traded over that period, which is about a year. As of June 15, 2022, the high for TCS in the last 52 weeks is 73,132.40 rupees, and the low is 4,043 rupees. Number 3. Infosys. Consulting, technology, outsourcing, and cutting-edge digital services are all areas of focus for Infosys Limited. As a technical indicator, the 52-week high-low compares the highest and lowest prices that Infosys stock has traded at since the beginning of that period, which is equal to 1 year. As of June 15, 22, the 52-week high for Infosys is 71,953.9 rupees, and the 52-week low is 1,399.25 rupees. It consistently ranks yearly as one of India's most reliable investment options. Number 4. HDFC Bank. The bank operates in India as a private bank and is called HDFC Bank Limited. The bank offers wholesale banking services like commercial and investment banking, and retail banking services like transactional and branch banking. HDFC Bank stock's 52-week high-low is a technical indicator showing the highest and lowest prices the company has traded during that period, close to a year. As of 15 June 22, the 52-week high for HDFC Bank is 1,725 rupees, and the 52-week low is 81,278.3 rupees. Number 5. Hindustan Unilever. Hindustan Unilever Limited is an Indian conglomerate specializing in consumer products. As a technical indicator, Hindustan Unilever's 52-week high-low represents the highest and lowest prices the company has traded over that period, about a year. The current price of Hindustan Unilever HUL is 72,911.55 rupees, a change from the 52-week high of 2,859.3 rupees, and a drop from that on June 15, 22. Extra factors to keep in mind. Choose a subset of financials and evaluate those using historical data in a time frame of at least 3 years. Pay attention to management quality, ethics, and corporate social responsibility (CSR) activities. Sort businesses by market capitalization and choose the top performers in each sector with a track record of success over the long term. Get your risk tolerance in line with the company. Research the company and the market to learn about your sector's challenges and opportunities. You should only put money into a firm if you thoroughly understand the business. In 2022, these were the best strategies and stocks to hold on to for the long term. Your bank account balance might increase by a factor of 100 or more over time. If you don't touch your payments in the middle, your profits will increase because they will be based on the total amount instead of the initial investment. Uncertainty and immediate danger may be removed with time. If you invest 1,000 rupees and get 10% profit, you will have 1,100 rupees after 1 year. If you let your money grow and don't withdraw your returns, you will have an extra 1,100 rupees in the following year. Use the same approach for more extended time periods and higher investment amounts. It takes time for an investment to realize its full potential and value. In the end, please subscribe to this channel and press the bell icon so if you're new to this channel, you don't miss any new stuff.